It's March 2020. You're 48 years old. A number glowing in red. $350,000. A month ago, it was over $450,000. $100,000 gone. 26 years of discipline, of saving, of believing in the system, and it feels like it's all vanished in weeks. The thought screams in your mind, sell, get out now before it goes to zero.
But let's rewind. It's 1994. You're 22, fresh out of college, sitting in a drab office cubicle that smells like new carpet and stale coffee. You hold your first real paycheck. It's not much, but it's yours. After rent, student loans, and groceries, there's a little left over. The world feels full of possibility, but also pressure. What are you supposed to do with this money? The question feels enormous. You remember something a professor mentioned, a concept pioneered by John Bogle at Vanguard. It wasn't about picking hot stocks or timing the market. It was a simple, almost boring idea, backed by decades of data from academics like Eugene Fama. The theory was that most active investors fail to beat the market over the long term. So instead of trying to find the single winning needle, you should just buy the entire haystack. Own a tiny piece of every major company through an index fund. It felt anticlimactic. No shouting traders, no ticker tape. Just a paper form, a check for $100, and a commitment to do it again next month. You open an account and set up an automatic investment into the Vanguard 500 index fund. The confirmation letter arrives. Your starting balance, $100. You've officially begun your journey as an investor, though it hardly feels like it. You've just planted a tree you won't see grow for a very long time. For the next 5 years, you stick with it. $100 a month, every single month. Your balance creeps up. $3,000, $5,000. Then, by 1999, it's over $15,000. The 90s bull market is roaring. It feels good. But at the office, the conversation is all about pets.com, Webvan, and theglobe.com. Your coworkers are bragging about doubling their money overnight on tech stocks you've never heard of. Your slow and steady index fund feels foolish. They ask why you're not in on the action. You're leaving money on the table, one says, clapping you on the back. You feel a deep pang of doubt. Are you being too conservative? Are you missing the opportunity of a lifetime? But you remember the data on market history. You remember the core principle, discipline over emotion. You hold on. Then, in March of 2000, the bubble bursts. The tech-heavy NASDAQ index begins a catastrophic slide, eventually losing nearly 80% of its value over the next 2 years. Your coworkers fall silent. Their guaranteed wins have evaporated. Your own portfolio, which had swelled to over $20,000, drops too. By the bottom in 2002, it's back down near $15,000. It's a 25% loss from the peak. It hurts to see the red, but the automatic investment keeps going. $100 buys more shares now than it did a year ago. You don't feel smart. You feel numb, but you don't stop. You are buying on the way down. And then, after years of slow recovery, something quietly magical happens. It's mid-2007. You're 35. You've been investing for 13 years. The market has fully recovered and reached new highs. You log into your account, maybe for the first time in months, and the number you see stops you cold. $102,000. You are, for the first time, a six-figure investor. All from just $100 a month. That feeling of success is brutally short-lived. Just 1 year later, in September 2008, Lehman Brothers declares bankruptcy. The global financial system, built on a mountain of subprime debt, teeters on the brink of collapse. This isn't a niche tech bubble bursting. This feels like the end of the modern financial world. The news is a constant, terrifying barrage of panic, bank failures, government bailouts, and fear. The S&P 500 goes into freefall, plummeting day after day. Your hard-earned $100,000 is decimated. You watch in horror as the value is sliced nearly in half. By the market bottom in March 2009, your account is worth just over $50,000. You've lost half your money in less than 18 months. Half! This is a catastrophic loss that makes the dot-com bust feel like a minor tremor. Every instinct, every fiber of your being screams at you to sell what's left, to preserve the $50,000. The fear is overwhelming. This feels different. It feels permanent. But what do? You've invested a total of $18,000 of your own money over 15 years. Even at the absolute bottom of the worst financial crisis since the Great Depression, your account holds $50,000. You haven't actually lost your contributions, only the market's spectacular gains. So you take a deep breath. You do nothing. Or rather, you do the same thing you've always done. The next month, another $100 is invested automatically. You are buying the market on a 50% off sale. What followed the 2009 bottom was the longest bull market in history. Because you didn't sell, you captured the entire ferocious recovery. Those shares you bought in the depths of the crisis for pennies on the dollar became the supercharged engine of your portfolio's growth. According to Vanguard research, a simple 60-40 portfolio that stayed invested from 2007 through 2017 ended up 87% higher. Your discipline paid off. By 2013, you had recovered all your losses and your balance hit a new high, $180,000. Which brings us back to where we started, that dark moment in March 2020. You're 48. You watch your portfolio drop by over $100,000. It's terrifying. But you've seen this movie before. You remember 2002. You remember 2009. This is the price of admission for long-term returns. You don't sell, you hold. And the market's recovery this time is shockingly fast. By August 2020, just 5 months later, you're back at all-time highs. Your conviction rewarded once more. Today, in early 2024, you are 52 years old. 30 years have passed since that first uncertain $100 investment. You have consistently contributed, month after month, through 3 recessions, a housing crisis, a global pandemic, and countless news cycles of fear and greed. Your total contribution over 3 decades, the money from your own pocket, is $36,000. You log into your account one more time. The number on the screen is $542,000. Your $36,000 of savings grew into over $500,000. This isn't a story about genius, luck, or risky bets. It's a story about time, discipline, and the profound, world-changing power of owning the market and then doing the hardest thing of all, nothing. The real return wasn't in the timing, it was in the time.